In this video, I'll be walking through the changes in the FRM Part 1 and Part 2 syllabus for 2026. So there are still 62 readings. There are no new readings, or there are no readings deleted as well. For Foundations of Risk Management, still 11 readings, no changes here. For Quantitative Analysis, there are some updates to the learning objectives. For chapter number 4 on multivariate random variables, of course they've just enhanced or refined the learning objective, but nothing major here. For hypothesis testing in reading 6, now they added on that you will need to be able to calculate the p-value from a test statistic. For reading 10 on stationary time series, now they have added that you need to calculate the time series for an autoregressive process using specified parameters. You need to calculate the time series for a moving average process using specified parameters. Then you need to calculate the lag polynomial of a time series process and apply characteristic equations to assess stationarity. Then you will need to apply model selection criteria to identify the best fitting time series model. And for box Pierce and Loom box, now they have added on that you need to know how to calculate and interpret the box Pierce Q statistic and the Loom box Q statistic. Then for chapter 13, it's just a minor refinement here. For financial markets and products, which is still 20 readings for 30% weightage, they have they have removed LIBOR, okay, from their reference. So this is consistent, okay, with the global transition away from this rate. For topic 4, valuation and risk models, no changes here as well. Still 16 readings, 30% weightage. So overall, it's still 62 readings for FRM Part 1. Now moving on to Part 2. Okay, now there are changes in the Part 2 syllabus. For market risk, just a very small change to the learning objective. Going from, for the first reading, they have just changed or update the learning objective from return distributions to asset price distributions. For credit risk measurement and management, for reading 9 on estimating default probabilities. So here they emphasize more on Altman's Z-score methodology and how we apply it to predict a firm's default. No changes to operational risk and resilience. It's still 24 readings. Then on to topic 4 or section 4, liquidity and treasury risk measurement and management. Now, for this section, it has gone from 19 readings to 17 readings. What happens is the reading 12, managing and pricing deposit services, have been deleted. And the reading on illiquid assets, which was reading 19 in 2025, it has been moved to risk management and investment management. And the rest have been renumbered. So in total, there are 17 readings in liquidity and treasury risk. Now, when we go on to risk management and investment management, so this has been a major change in 2026. So there are now 17 readings in this section. So what they've done is they've deleted risk monitoring and performance measurement. They've deleted hedge funds, and as well as deleted the reading on finding Bernie Madoff, predicting fraud by investment managers. And they have renumbered some of these 2 readings here. But of course, what they added would be a few of these, like hedge fund investment strategies is new. There's risk regulation and organizational structure. Then you have the rise and risk of private credit, which was moved from current issues in financial markets. This used to be in the 2025 current issues, but now in 2026, it's been moved to investment management. And we have another new reading on private markets investing. Then you have distress symptoms and remedies. And then another, of course, reading on Bernie Madoff. It's got a riot of red flags. Then there is market-driven scenarios and approach for plausible scenario construction and liquidity risk management. Okay, and then we have the illiquid assets, which was moved from liquidity and treasury risk. So this has seen the biggest change in 2026. Then on to the current issues, which is, of course, they will update this every year, and we will always expect a big change in this section. Now, the first 5 readings have been deleted. As you can see, like they're moving away from the bank failures. They're not going to talk about Credit Suisse cases again. Okay, then they've deleted some of the readings on AI. Okay, interest rate risk management by emerging market economies banks, laying a robust macro financial foundation for the future. Then the rise and risk of private credit have been moved to investment management. Then the rest are renumbered. So only three readings have been maintained. Okay, these are mainly on monetary and fiscal policy, the crypto ecosystem, and digital resilience. Then what is new here would be AI again. Okay, so we have a new reading here on advances in artificial intelligence, implications for capital market activities. So you can see in 2025, they included the reading, but it was focusing on central banks, but now they're focusing more to capital market activities. Then there is a new reading on the financial stability implications of artificial intelligence. And surprisingly, there is one on private credit, but this focuses more on global drivers. Then there is a reading on global financial stability report and one on tokenization and financial market inefficiencies. And of course, the rest, these three are renumbered. These are the ones maintained from 2025. So overall, if you look at the total number of readings, it has gone from 104 to 107 readings in 2026.